So welcome everyone. We have been doing religiously webinar every Friday, but this time, we had to do it on Thursday because of some exceptional reasons. So my, sincere apologies to all our viewers to have made this one change. Also, this webinar was supposed to happen with Nilesh Doshi, who is the founder of Green Lantern, but he is unwell, and that is the reason we are doing this with Abhishek Bhardwaj, who is co-founder with Green Lantern. We'll try to do justice to whatever expectations we have set. Green Lantern is one emerging strategy in the PMS space which is doing really well, and the aim of this webinar is to deep dive that in the full, I would say, sense, as we always do, across all our parameters. Welcome Abhishek to this webinar. And the title that we have kept for this webinar is to understand Green Lantern strategy, which in short, we understand as growth investing with margin of safety. And that is what, we will want to understand. I also have this understanding that Green Lantern follows a top-down approach. It's a differentiated approach. Most fund managers talk about, being bottoms up. They focus too much on business, but Green Lantern does it differently. It focuses on top-down, and which also makes it very interesting and kind of makes it all the more interesting for a conversation, because today we know a lot is happening in various sectors, in various themes, and a strategy which actually is doing top down is able to see big picture and is able to take some, I would say, understanding of upcoming trend. As we know, trends are changing fast. So obviously a lot to discuss, as we move forward in this discussion. I have set the context for you, Abhishek. And to begin with, I want you to address that. What is it that you are seeing at present as a big picture, changing trend? Because we have been seeing over last, say, couple of years, some of these value businesses, or you can say old economy businesses from infrastructure or PSUs, or I would say stocks which had actually not participated in earlier growth focused rally, which happened in the past bull run, has kind of that trend has changed. Like, for example, the leaders of earlier bull run were stocks like HDFC Bank, and now the leaders are like, you can say, stocks like SBI. So that trend has changed. So when did this trend change? How did you identify? Where do you see this trend moving now? Is this trend again going to change soon? So I want you to address this, big context, and then we'll fine tune further.
Thank you, Kamal. Thank you for hosting us on this webinar. And again, I kind of apologize from the side of Green Lantern that Nilesh Bhai couldn't make it. I'll try and do as much justice as possible with this. So, Kamal, you have pointed out correctly that we focus to some extent on top-down approach as well. And that's an important component of our portfolio construction. To your point as to how we see things as of now in the current environment, and when did this change started to happen in the market? So, Kamal, I think what happened over last 1.5 decade was, ever since a lot of money was being printed to solve the problem that developed world faced, I think as cost of capital came off and a lot of money was pushed into the system and capital became cheap, I think a lot of these businesses, which were good businesses, kind of re-rated over a period of time. They continue to deliver these growth businesses, and they've got re-rated over a period of time. And the other part of business, which was the capital formation, which was manufacturing side of business, which is the old energy part of the business, kind of became a bad word globally, not just in India, globally, and consequently did not attract any investment at all, whether it was energy, power, fossil fuel based, or even ICE based engines, etc. All of that kind of became sort of untouchable, if I could say that. And with that as background, since investment did not happen, even listed market equity investors kind of moved entirely to other growth kind of businesses, and that's where the entire money was. I think what happened post-COVID was a couple of things which have happened. One was, I think, supply chain got disrupted during these times. And suddenly there was this concept of nearshoring of diversifying your manufacturing basis, and that meant that the focus had to be back on manufacturing, on ensuring the supply chains, something which was functioning very well for last decade or two, more than 1.5 decades, suddenly sort of was in question. The other part which happened after Ukraine-Russia war was the need to have energy security. I think countries suddenly realized, both developed and developing, they realized that energy security is very important, and they cannot take their current energy source for granted, because everything got disrupted. Europe, which was buying from Russia, started buying from Middle East. Asian countries got priced out of that. So all of these brought about a lot of thought process change. One, it brought about focus on self-reliance for the world, geopolitical tensions along with what happened in COVID, plus energy security. And these two meant that some of these businesses, say a fossil fuel-based power generation business, which I think market was considering as having very little or zero terminal value, suddenly looked like, to some extent, I can even say that growth businesses, while their valuations are still not there, but yes, they have done well with NTPC moving up 100%, something that we have not seen ever since it got listed, or Coal India doing so well. This is primarily because these sectors were so much neglected, and now that there is focus on energy security. And for India as a country, I think we believe that it is these fossil fuel-based, coal-based energy sector which kind of protected us during the Ukraine-Russia, when the disruption happened. So I think government has a lot of clarity there that these need to be increased, these need to be pushed. So suddenly these are looking like areas which will see expansion in earnings, in growths. And since market was not considering any terminal value to these businesses, these were trading so cheap that they've got re-rated. Investors, particularly institutional investors, were entirely on the other side of the trade, which was doing well for over a decade or so. And I think that is where some of the moves that we are seeing in these stocks is also exaggerated, in the sense that since these are less owned or under-owned stocks, any shift in capital which happens to these segments is leading to a higher change in prices that one would normally expect with the kind of earnings that we are seeing. So while we are not surprised with this move, because we were of the belief that both oil as well as power had not seen any investments, and if India as a country has to grow, if manufacturing has to be our focus, and manufacturing as a component of GDP is far more energy intensive versus a services driven economy, we were clear that investments have to come into this. To keep our cost of power low, we'll have to invest on coal-based power as well, on renewable as well, across the board. We'll have to make investments in oil and gas sector as well. So we are not surprised, but yes, of course, the pace of the move kind of takes everybody by kind of, in a way, a surprise. The pace, not the move itself.
Sure, Abhishek. I think this is very enriching. You will have to put yourself on mute after every discussion. Right. There was an echo. So, Abhishek, this is, quite insightful. I think a lot to learn. And at the same time, you guys had identified this trend very early. I know some of the power stocks. I don't want to discuss those stocks at this forum, but that trend Green Lantern actually identified well. And that is one of the reasons why the performance in last 1.5 years has been really good. And over last 5 year, obviously return has been, consistent, because in the past also you would have identified similar trends. And maybe this is also because your AUMs are less and you're able to kind of, manage moving out from one trend to the other trend faster. So this is what is the beauty of a boutique PMS. We understand that really well. What from here onward, I want you to kind of address is what is it that Green Lantern as a PMS strategizing or seeing as a trend now? Because to an investor as well as to an advisor like us, it looks that markets are overheated. Small and mid caps have become very expensive. Though investors are kind of wanting to invest, but these investors are experienced investors who have had in the past some of the bad experiences also. If they had invested at a bad time, they don't want to just fall trap to recency bias. They want to invest. They are risk takers. They have long term horizon, but they don't want to have an unwise entry. How do you see current timing, current levels, and how are you managing this thing, and what are you advising to clients in that context? Because there are some mutual funds which have stopped taking money, some big PMSs which have stopped taking money, which is like kind of trying to spread a message that opportunities are less and maybe risks are more. But at the same time, somebody like you, or Green Lantern, that is what you represent, I want to understand your perspective.
Sure, Kamal. So just to step back a bit, I mean, since you touched upon power as a segment, so it's been something that we've been doing consistently. And earlier, we were quite early in identifying manufacturing as a theme way back in 2019, 2020. And we've done well as far as our capital goods exposure earlier is concerned, or IT exposure that we had, or even some of the pharma names that we had earlier in this cycle in 2021, 22. So it's been, since a part of the portfolio is top down, we kind of try and see that if, along with good management, if we can identify a sector which is witnessing tailwinds, it will further increase the probability of making higher returns. So that's the entire thought process of kind of combining the two engines, which is good management along with the sector tailwind. So that's the thought process. To your particular question of in the current environment, how we are seeing, Kamal, one cannot deny the fact that what we have seen over the last 2, 3, 4 years, and particularly last 1 year, has been a market which has run up reasonably fast. And some of the reasons, as I talked about earlier as well, because some of these segments were under-owned and they kind of surprised the market in terms of how market was positioned with respect to the earnings that these companies have delivered or the outlook which has happened. So part of the reason is that as well. Part of the reason is, of course, it's a good bull market, and these are the things which do happen. Just to step back a bit, where are we really in the cycle overall? I think as a country, we are very well placed as far as all the factors are considered, whether it is demographics, whether where we are in our cycle as far as reforms are considered, that it's the manufacturing as a segment is not just will be driven by exports opportunity, which is the case that we have seen with countries like South Korea or Japan, and to some extent China as well. A lot of our manufacturing is supported by the domestic consumption because we end up importing a lot of things. And here is a government which is really supportive of this theme. They're making investments in infrastructure. They're making policies which are conducive for this, attracting foreign investors to set up base in India. So that's one part of the story. The other is the kind of population that we have, which is English speaking, which has always been driving the services sector growth for us, whether it is IT. And now we believe there are other engines as well. And we believe engineering exports will become, again, an equally large space. So there are a number of factors which will kind of, which provide us a visibility over 8 to 10 years. We believe that our small and mid cap sector as a segment, not just for equity markets perspective, but overall also, we are at the cusp of technological change globally. A lot of new industries and businesses are being created. And in that environment, we've seen that whenever a technological change happens, a lot of new companies, not of companies come up, while over a period of a decade or two, 80% of them don't survive, but the ones which survive make huge amount of wealth for investors. The case in point has been what happened with telecom sector, with the mobile connectivity, with when two-wheeler sector started off with Hero, Honda, etc. So the ones that survive make huge amount of wealth, and something similar is happening now with EVs, with AI, with what we are seeing on the e-commerce side, etc. So this is one part. The other is our focus on manufacturing. And when Maruti created such a large ecosystem, imagine the kind of manufacturing that we are trying to do, which will again create a very, very large ecosystem of small, mid-sized companies, which over a period of next 10 to 15 years will create huge wealth for investors. I think one has to be careful about backing the right management and the right business models, the ones which are minority shareholder friendly and kind of are careful with their capital allocation philosophy. But as long as you get your management and business right, I think over a period of time, you'll make good money. So with this as a background, with government doing all the right things, a lot of money waiting on the sidelines to enter the country, do we expect India to trade very, very cheaply in the current environment, unless there is a very large COVID or worse than COVID kind of accident? I would say not really. Can there be corrections on the way? Since we have gone up so much, will there be corrections? Of course, it's been part of market. One has to be, investors have to be prepared for volatility. This year, we expect should be more volatile than the previous year. The outlook, long-term outlook remains good. There can be corrections in the journey. If can there be a very, very large correction? Well, then it would require something like COVID or worse than a COVID kind of event, which we believe again will be followed by, because central banks understand only one way of kind of solving this problem, by printing more money, which will create a further inflationary cycle in the world, which would mean that the kind of stocks or things which are working now, after a correction or after whatever we see at that point in time, some of these things will come back with a vengeance. So because of the way we expect those problems will be solved, which will be even higher printing of money than what we have done this time. So that's our thought process. We are focusing, as of now, our focus is entirely to choose companies which we think can see an acceleration in earnings from here on as well. Businesses which can surprise on the upside as far as their top line growth, margin expansion, and can see a re-rating as well. So that's our entire focus in our research. But in the interim, can we deny that there cannot be or will not be a correction? I don't think. Over last 3 decades, we have seen there have been number of corrections in the market. Correction could happen in any point in time, 3 months, 6 months. Very difficult to predict when it will happen. But yes, we are focused entirely on businesses which can see a higher earnings growth from here on as well.
Sure, Abhishek. One thing, which if I put myself on investor's shoe comes to my mind is that, if investor has to take a decision of investing in your PMS now, obviously, he would want to, he's sitting on money, as you said, a lot of money sitting on sidelines. It will be easier for him to take that decision if you allow him to stagger his money over, say, 6 months or 12 months by giving him an STP kind of option. So many companies offer that, but you do not offer that, which is obviously, your strategy. But we want to understand the rationale behind that strategy, and what would you advise to an investor who has a long-term horizon, and how would you kind of give him maybe a logical comfort? Obviously, future is unpredictable, things can go wrong, but still there will be some strategy that you have when you're accepting money, and you're accepting money in lump sum. What is that strategy all about? And how do you reply to such a concern of an investor?
Sure, Kamal. So a couple of things. One is how we manage money. So when an investor comes in, we don't replicate the portfolio. So we don't follow a model portfolio approach. What happens with us is whenever new money comes in, fund manager would sit down and decide the stocks that he's comfortable at that point in time on that particular day. So at any point in time, it could be 60% of portfolio that we are comfortable buying at that point in time, 50% of the portfolio. It could be any number. It could be 70% of the portfolio. As we speak, the number hovers around 50 to 60% of the portfolio that we are, it depends. I mean, if the run-up happens, it may be even lower than that. So that's one part, that we are not straight away investing the entire money. While we are accepting money in lump sum, we are not investing the entire money at one point in time. We only invest. So two engines for us work separately. One is we are looking for opportunities, incremental opportunities, which meet our margin of safety, our criteria, and as and when we get those opportunities, we deploy the incremental amount of cash. Second is whenever we find that stocks which kind of have come in our sell list because of how we see their future, what they are pricing in at that point in time in terms of valuations, or how they are behaving as far as their business growth is concerned. So that operates separately. So those are the sell ideas which are generated. And in the interim as well, there can be cash. So one is there will be cash till we find the right opportunities. And secondly, even when we sell, there'll be cash in the portfolio. So these are the two things where we are a little different, and we don't believe in remaining invested absolutely all points in time. Why we don't go for a STP kind of is because when we find the right opportunity, we don't want, because we have committed to investors that we will invest only 20% in 1 month and 10% in another month. We don't want to tie our hands with that. What we have seen in the past is at times you get very high conviction ideas. I mean, how we built this portfolio in last 3 months, 6 months, 2 years has been that you're working on certain ideas. At any point in time, we are working on a lot of business ideas. And what we do typically is, other than trying to buy things at value, we are always on the lookout for right triggers. So we don't buy things just because they are cheap or they kind of meet our valuation criteria. We are also looking for certain business triggers. So if and when we find those business triggers, and you would understand that such opportunities are not always available, but when they are available, you want to grab them with both the hands. You don't want to tie your hands by committing to investors that we will not be investing. So that's our idea, that leave the discretion of investing to us. We are anyways not the kind of investors who are of the belief that we should replicate the entire portfolio as soon as the money comes in. We are not of the belief that we will remain fully invested at all points in time. If a part of the portfolio is something where we believe it's pricing too much into future, we will book profits. We are quite disciplined around that. We are of the belief that in mid-cap, small-cap companies, you get to sell when the prices are rising. That is where there is liquidity. So we do book profits. So I think we are fairly conservative as far as our management of money is concerned. We don't want to add another layer to that by tying our hands.
Sure, Abhishek. So what is the churn, average churn of the portfolio over last 5 years, and what has been the churn in last, say, 1-2 years portfolio?
So it's been around one time here and there, depending upon. So it keeps varying in the environment that we had over last 2-3 years. What we have witnessed is cycles have really shortened. Businesses that you would expect, or stock prices to kind of price in certain things over a period of 2 to 3 years, we have seen markets pricing in within a span of 6 months or 8 months. And this has led to kind of increased churn in our portfolio, something that we don't intend to or don't plan to. I mean, we have bought stocks with a view that we'll get price in 2026, and we have seen that happen from March to now. Some of those stocks are in our portfolio, and some of those we have already sold as well. So it's a function of what's happening in the market. Cycles are much faster. It's also a function of that some part of the market was very, very poorly owned. And that is why the moment market is seeing with such strong visibility in earnings, that there is a lot of catching up which is happening in the market and has increased our churn in the portfolio.
Sure. So churn, which is done to obviously book profits and move on to better margin of safety, is absolutely welcome. So how do you identify now in the current context whatever portfolio you are holding? So I understand their portfolio is like 75% invested and 25% you're holding as cash. So whatever 75% portfolio you're holding in equities, what is the current, I would say, attribute of that portfolio in terms of earnings growth, valuations, and how do you define margin of safety in that portfolio?
Yeah, so I'll just maybe start with the margin of safety and then give the data points on our portfolio. So typically, for us, margin of safety comes from two things. It comes from the fact that we should not be overpaying for the business, which means that even if some of our assumptions go wrong or business does not deliver on the lines of what we expect it to do, there is little downside for us. So that's one part is on the valuation part. The other is business cycle, and which is equally important or rather more important for us. So where we are on the business cycle. So we may not be comfortable paying reasonable valuation or low valuation for a business where we think that it is towards the fag end of its upcycle. And we may be happy paying in terms of earnings multiple, we may be happy paying much higher multiple to a business which has been struggling struggling with its margins for some time or business cycle for some time. And that's how we kind of define our margin of safety. So case in point has been businesses where we've bought companies which for last couple of years was making very little margin or less margin, but was available at forward earnings as far as our numbers was concerned 12 to 13 times forward earnings. And for a business where some of the peers were trading at 30-35 times earnings or even higher than that, and that makes something very attractive for us. If one only looks at the historical numbers, somebody who has little understanding of the business will kind of struggle to understand the valuations in that context. Our current portfolio, as far as valuations is concerned, is around 18 times earnings, forward earnings. It's trading at around 18 times forward earnings for an earnings growth of over 23-24%. With some of these companies, we are quite conservative in our estimate when we are trying to estimate. I mean, one of the companies yesterday delivered earnings and the stock was up significantly. And in its quarterly numbers, it delivered on a run rate basis, it delivered numbers that we were estimating for FY26 full year numbers. So exit rate for this quarter was that. So we expect some surprise to our numbers as well. Usually that's our idea when we are trying to do our numbers on keeping the margin of safety in mind. So that's where we are as far as the valuations are concerned.
Sure, Abhishek. So I would like to really understand, now because this conversation is going in a very interesting manner and there is a lot to learn. And I have been interviewing various fund managers. This is going in a different direction. You are more sounding like an analyst than as a fund manager, which is like very good, and which is what is developing all the more confidence. So I want you to kindly take an example of any particular stock or a business, that how did you identify that, how did it all start, in your office you were discussing certain theme or a trend, and how did you ultimately reach to that trend, and within that ultimately found that in that particular trend there is a sector and in that industry and then this stock. How did this all happen? If you explain that, and then obviously while you would have selected a stock, you would have rejected few stocks on grounds of margin of safety. right? So if you take one example, one case study, then that will kind of explain this in a more interesting manner.
Yeah, sure, Kamal. So maybe a more recent example, and maybe I'll just towards the end touch upon something that we did earlier as well. But this is more recent and something that I've talked about partially in this webinar. So something that we were quite positive for almost 3 years was power as a sector. And again, as I outlined earlier, because we were positive on manufacturing as a theme, we were very clear that investments have not happened in the sector. So we were quite positive on power as a sector, as a segment that we have underinvested. And given that data centers are coming up in India, EV will be there, manufacturing focus, the power, we need to make huge amount of power investments. Our confidence was further increased when there was Ukraine-Russia war, when there was this focus on energy security, and we realized that a lot of investments will happen across the world, not just in India. We believed that the focus on renewable was always there, and now with energy security, grid investments, which has not happened in Europe and US, they too will have to start making investment in their transmission and distribution network on the power side, along with India as well. So we thought that this is the only time in the history that almost the entire world will be making investments in power sector, and at a time wherein companies that can deliver those equipments have reduced, because developed world was only making incremental investment for their maintenance. China is more or less done with, and some of these Chinese companies are now untouchable in the developed world. India too is not welcoming these companies. So this to us presented a very good environment theoretically to look at this particular segment. The interesting thing was, because investments had not happened, most of these companies, at least on their historical financials, did not look great. They had technical capability, but they did not look great on their reported numbers. On top of that, what has happened was from 2020-21 onwards, after COVID, because of supply chain disruption, there was a lot of inflation. And as you would know, in a low demand environment, whatever orders that are available with whatever conditions, those are being taken, and a lot of these companies had taken those fixed price contracts and were suffering because of high inflationary environment where steel and all the costs went up. So they were suffering from that. Parallelly, so we started looking at that, and we bought one company within that, which kind of was more disciplined, which was reporting decent numbers, which didn't have historical problems, and was meeting our investment criteria. But I'm not talking about that. I'll talk about another company, which was part of the portfolio, something that we are not recommending at all as of now. The stock has run up a lot, but we are just giving how we kind of thought about that business. So the company is GET&D, something that we were looking at since maybe over 1 year. We were tracking what's happening in the business, and their margins were volatile, and they were suffering because of some of the past orders. Towards end of December 22, a lot of clarity started emerging about India again stepping up investments on the renewable side. And CEA came out with a discussion paper, that 500 gigawatts of investments will take our renewable energy to 500 gigawatts from 166 gigawatts. Interestingly, what you have to do if you're doing renewable energy is, because the gestation period is lesser versus thermal or hydro, you need to make upfront investments in transmission and distribution. Because unlike thermal, hydro, which takes 5 years, 6 years, 7 years to come up, solar or wind can come up in 1.5 years. So you need to start making investments in transmission, distribution now. So that was one thing that we realized. These investments will start happening now. They talked about other thing very interestingly. They talked about was so they were talking about two increases. One was circuit kilometers, which is the transmission lines that you put up, and MVA in substation capacity. The talk was we will increase our substation capacity from 11 lakh MVAs to almost 15-16 lakh MVAs, so almost 50% jump in next 7 years. The more interesting part, which helped us select 2 companies and 3 companies in our current portfolio, which have done very well, is that they talked about more than doubling the current capacity. So that is where understanding of business in which companies benefit in the process becomes more important, where you understand that there is much lesser competition. We realize that they're talking about increasing the 765 kV, 800 kV substation capacity by more than double. So the talk was whatever we have done till now, they were talking about more than doubling that capacity in next 7 years. Now that was very interesting because here was this company, GET&D, which was to participate in that space. Now the space looked more interesting because a lot of players, particularly on the transformer side, capacities had closed down. The ones that survived, they were operating at reduced capacity. And demand was increasing. A company like GET&D would benefit from investments across the globe because it is one of the 3-4 companies globally which has the technology for HVDC transmission lines. It's a high voltage direct current transmission line where your transmission losses are half of the normal. So it is only one of the 3-4 companies which have that technology. It will participate in global orders, which we are seeing now, but that was the idea because again, HVDC lines, the talk was, will double in next few years. US will start investing, Europe is doing. So the idea was that already there are projects which will double the existing global HVDC lines as well. So there is global opportunity, there was domestic opportunity, number of players had reduced. Then it boiled down to actually what the company is doing. So of course, theoretically it looks good, but then you have to also understand where the company is positioned as far as its orders are concerned, as far as, so I mean, I'm just giving an idea, maybe it's a longish answer, but I'm just trying to give you a sense as to how we kind of concluded. So one was a top-down view and how we kind of come up. So we were tracking this company. In December quarter results, few things happened. One, their gross margins expanded significantly, almost 500-600 basis point, if I remember correctly, was the gross margin expansion then. So it gave us a signal that some of the past issues with the high inflation, which that they were suffering from, it is at least partially behind us. In the new orders, they are seeing an expansion in gross margins. Their order intake went up significantly at that point in time. So they saw some 700 or 800 crores of order inflow. The commentary was very positive. Their balance sheet looked good. They had, I think, around 200 crores of debt at that point in time. They were making, I think, around 5.5-6% margins. In a normalized environment, they made double-digit margins. And our sense was the kind of demand that we are seeing in the current environment, over a period of next 2 to 3 years, they will make highest ever margins. When a situation, if we are foreseeing a situation that we have never seen in investments, where the demand environment is such that there will be lesser players, there will be far more demand than what some of these players can meet, then there will be a significant gross margin expansion. So our numbers suggested that they'll make a reasonably high double-digit margins. But even on a normalized double-digit margin, it suggested that the business was trading at 2025, it was trading at around 12 times earnings. Now, historical numbers, it looked a little expensive, but the business was available at 3,000 crores market cap. Its turnover was 3,000 crores. So you are getting an MNC with niche technology capability at one-time sale at the bottom of a certain cycle, which we believe will be a 7-8 year cycle. Global opportunity, very well placed as far as HVDC orders are considered. Basically, the talk is that HVDC opportunity in India itself will be 25,000 crores per annum, and there are 2-3 companies which will participate in that. So that is, I mean, for us, that was really the margin of safety that we would look for in a business when we are buying. Something like this. Of course, the stock from 120 when we initially started buying, 120, 115, 120 to now it's kind of 800. It's not something that we are buying as of now and not recommending at all. That's what I was talking about, that something that we could not have visualized. We thought that we may see some such price in FY26 or so, but market in its wisdom has kind of re-rated the business this extent, this vast. Any questions which we have? I'll quickly otherwise touch upon a earlier case as well.
Sure. Yeah. So this is really, very bright example that you have taken. And so you can take the earlier example also. Yeah, please go ahead.
Yeah, I mean, those were then the times. So this is relatively, I mean, these were the times wherein you have to be on the right sector and kind of be more choosy about the businesses and companies that you select, because a lot of sectors over a period of time had already seen a run up. But the other name that comes to my mind, something which we bought again with good margin of safety, was Elecon Engineering. But so here we could time it with trigger. So that's why I'm giving another example where the trigger was not necessarily on the horizon, but business was available very, very cheaply. So that was another was into when we bought in 2019, which was Elecon Engineering. It was a micro cap company then, but was available at half-time sales for us. It was, I think, around 5 times EV to EBITDA, a business. So it's a gear manufacturer. It is the largest gear manufacturer in India, even in Asia. It makes industrial gears. It's a proxy to a lot of capex which can happen in the country. And then it can happen. Power sector, sugar, metals, etc. So it's a play on that. So our idea was the business which was operating at around 45-50% capacity utilization, a business which has almost 50% gross margin, will see huge operating leverage the moment capacity utilization increases. Since there is big gross margin, it's operating at low capacity utilization, and even at that point in time, it was available at 4.5 times. It had a stretched balance sheet in terms of working capital, but resolution of that was visible. Some of these orders were closer to completion. The stock was then at around 45-50 rupees. During COVID, it came all the way to, I think, less than 25, maybe even 20. I don't really remember, but around that. And we have sold along the way. So we have not captured the full upside, but as we speak, it's upwards of 1,000 rupees. So, but those were easier times because a lot of companies have done reasonably well. But again, this was a business where we had so much confidence that even during COVID times, when the stock would from 45-50 rupees kind of came off to almost half of where we bought. But the margin of safety was so huge that there was no reason for us to really question our hypothesis.
Sure. You also mentioned in your last statement that those were easier times. So are the current times difficult in terms of, identifying, I would say, similarly, opportunities? This is one thought that comes to my mind. Second thought comes to my mind is that while you were talking about energy sector, I was also running a poll, amongst 4 sectors, which is one sector which audience believes that will be a top performing sector, outperforming sector, even in 2024. Again, 46% people believe it's energy. But at the same time, I was checking some of the valuations of companies in energy sector. The median PE of energy sector comes to around 45. So the company that you talked about earlier, in the earlier example, its PE is upwards of 200 in the current context. And, if I give data on PE of G&T India, it's 234. If we talk about Suzlon Energy, PE is 134. CG Power is 76. Apar Industries, is having a 30 PE. Siemens around 80 PE. ABB around 78 PE. BHEL PE around 1000. So obviously, there is definitely a euphoria in favor of energy sector because these companies have not performed in the past, and as you mentioned, they were under owned. But do you see now they are over-owned and there is this too much euphoria, and maybe, one who is investing now is going to get trapped? Because as you also mentioned, that what you were expecting to happen in 2026 has already happened in 2023. So people who invest now maybe make no return till 2026. Does this imply the same?
So Kamal, I'll start with the first question, which was, are these times relatively more difficult versus 2019? Well, the short answer to that is yes, no denying that fact, because we've seen a lot of sectors have got re-rated. We have seen a lot of business cycles which have played out, and after 3-4 years of run-up, is it as easy to find opportunities to invest as it was 3 years back or even 1 year back? The honest answer to that is no, it's not as easy. Having said this, one can still identify businesses. We sometime back again bought a business which was cap goods sort of business, which was trading at one-time sales, again with good capabilities. So a business which has a reasonably large turnover, upwards of 4,000-5,000 crore of turnover. So it's not a very small company as well, and where we see good return potential. So are we finding such opportunities over the last couple of months? There are certain opportunities, but yes, not that easy. I think the important point to consider here is it's an evolving and a dynamic world. Has power sector got re-rated, and some of these names, are we very comfortable buying at current valuations? Well, the answer is no, not all of them. And most of the names that you have talked about, we are not buying them as of now. While they will see a very sharp acceleration in earnings, very sharp increase in earnings, and something like GET&D will see a very high earnings. So on a forward earning basis, it's not trading at where it is trading, but still it is not at the comfort level that when we bought, or where it was even 3-4 months back. So that is very clear. The reason why they have kind of seen such a sharp up move, this sector, is because the earnings jump is also not in 10, 15, 20%. With some of these businesses, you will see a very, very high jump in earnings, because all the levers that can work when you're playing a stock are working in its favor, which is gross margin expansion, which is sales growth. Operating leverage will come into function. Your working capital cycle will improve in this environment, because your payment terms, because of scarcity environment, payment terms will improve. And of course, since the earnings acceleration is there, these companies get re-rated and get a much higher multiple. So that's been the reason why they have run up. So I am not really of the view that some of this move is wrong, just that it's happened a little faster than how one would have really liked it to be. While we were in the sector, we are pretty happy. But yes, so there is, in particularly with some of these names, there is less margin of safety. There are other names which are less popular, which where there are underlying earnings drivers, where these businesses will see some of these drivers play out, and optically they may look expensive, but eventually they are on a forward, because market is usually forward looking and kind of rewards your delta from there on. They may not be as expensive there. So energy remains a theme which is interesting for us. Energy remains an area where on the oil and gas side, you will see huge amount of investments, 20 lakh crores of investment plus, where in power generation, distribution, transmission, metering, everywhere you'll see huge investments. Cap goods as a segment, manufacturing will see investments. But yes, one will have to be a little careful about businesses that you are buying, and some of these businesses which have seen a very, very sharp run-up, one will have to be careful, and we are also choosy about the businesses that we are buying at that point in time. So we are looking elsewhere as well. So it's not necessarily just energy as a sector, where we are finding certain bottom-up ideas, certain other opportunities as well. But from a long-term perspective, this theme remains attractive for us.
Sure. While you construct your portfolio, obviously we have discussed that you identify an upcoming trend and then identify business, which is good management, is a growth business, and then you enter at a good margin of safety. And then obviously we also understand that, it's a PMS with around 20 stocks. So it's a high conviction portfolio, which is also quite understandable. But then, how do you kind of create the overall portfolio in terms of choice of sectors, percentage allocations to various sectors, allocations to some of the, I would say, heavyweight sectors in index. For example, financial services is a heavyweight sector in index with 30-35% weights, right? So do you have such thoughts when you're constructing a portfolio, or you keep it absolutely agnostic to index and you kind of concentrate across only, say, one or two sectors, or you diversify it, amongst various sectors? And then while constructing a portfolio, you also try and keep in mind some weights towards mid caps, some large caps. You think it like this, or you only focus on the earnings growth and the valuation comfort?
Yeah. So Kamal, so as investors, one thing is very clear. We understand that we are dealing with probabilities, and no matter how much effort we put in to understand businesses, there are always uncertainties, and there are always things which can happen, which can question your hypothesis, and which can derail what management is trying to do, and what. So diversification is very, very important for us, and it's something that we are always cognizant of and always do in our portfolio. Our idea is to have uncorrelated portfolio stocks. So we may not diversify in the traditional sense of how one may look at. So one may qualify certain stocks to be cap goods, and we may believe that certain part of the portfolio is renewables and other part of the portfolio is corporate capex. And from a layman's perspective, all of that could be cap goods. So because our belief is these are unquote. So that could happen. But yes, there are certain limits. We don't go beyond 20% as far as sector allocation is concerned, no matter how much we like a particular sector on a top-down basis. But while allocating on a cost basis, it doesn't go beyond 20%. And even when on a current price basis, if it moves up on a particular position, also if it goes beyond 10%, we typically prefer to trim our positions, even though we may be positive on the stock. But if it goes beyond that, from a risk containment basis, we trim our positions, and even on a sector allocation basis. While constructing the portfolio, indices weights are not at all important for us. So we are kind of investors who believe in sticking our neck out. So you will see our view reflect in our portfolio, and not just by being overweight and underweight on sectors. By if we don't like something, if we believe there is a higher potential to make returns in a certain sector, we will have a much higher weight there. And if we believe that there are challenges and the most business in that sector will kind of face headwinds, it may not have any allocation in the portfolio, or very little, if any. So banking, while we overall like banking as a sector, we are not kind of bearish on the sector. Most large names, since they are very well tracked, very well owned, don't leave much for us on the table. So earlier in this cycle, we had some of the largest names within the banking and financial services as part of the portfolio. As you asked, do you have large caps also in the portfolio? So yes, when it made sense. So we are within a sector, we are agnostic to market cap. If within a particular sector, if we like, and if we are early and we believe that large caps offer a lot of margin of safety, we are happy to own them. When it was metals, when we owned amongst the largest ferrous metal company in our portfolio. In banking, we were owning the largest two banks, amongst the largest two banks in the country in the initial part of the cycle, which is 2020, 21, 22. In that journey, somewhere we sold and moved to the mid-cap stocks. So yes, liquidity of the portfolio is important for us from a portfolio construction perspective. Understanding the risk that we are taking, that is equally important. So we try and have a reasonable mix of some large caps, but these are more of a function of our bottom-up idea, where we think that large cap offers a good margin of safety. Of course, in a large cap, typically we are not looking for a multi-bagger return, but if it so happens, which was the case with earlier in the banking stocks or in metal companies or some of the companies in the cap good segment, then so be it. But it's also a strategy to have the right mix of large cap and mid cap in the portfolio.
Sure, Abhishek. I think this is going really insightfully. I will just take the last question that comes to my mind. More or less, I'm quite convinced that your strategy is quite, I would say, competitive and quite capable to be offered to our clients. But at the same time, obviously, it is like not meant for everyone. One needs to have a full understanding of how mid and small caps work, and we have statistically studied your portfolio in terms of beta, alpha, standard deviation, and we know who are the right profile investors for whom this portfolio makes a lot of sense. But moving on to last question, you mentioned that currently your portfolio is maintaining 25% cash, and for new clients you invest in a very gradual manner, and you do not want to offer STP because obviously you do not want to contain your possibility of encashing an opportunity when it comes and when it is absolutely high conviction opportunity. But in the history of last 5 years, we have seen a lot of events happening like COVID, and then we saw your beginning was in 2016-17, and then after that there was a event in 2018-19 where markets were kind of mid and small cap segment was not doing at all good, and many PMSs kind of went out of name. Right. So you obviously have gone through those cycles and you have seen those cycles. So I want to understand that what are the maximum cash levels you have ever gone at, and what are the minimum cash levels you have ever gone at in the past, and how was your performance between 2017 and 2020? Because 2020 and 2023 we know performance is good. So these are the two aspects that I want you to cover, and then we'll wind up.
So as far as the cash levels are concerned, maximum cash that we would have gone would be around 40% in an environment where we are kind of struggling to find right opportunities, and we have generated a lot of sell ideas in the portfolio. So in this last 3-4 years, there have been a cycle from October of 21 to March of 23 as well, wherein small and mid caps were not doing well. And I think even Nifty returns were flattish in that environment. How we kind of navigated the environment was during that time, since from April and May of 2020 to October of 21, markets had seen a very sharp run up in a lot of sectors, all the way from pharma, chemicals, IT, had seen a very, very sharp run up. A lot of sell ideas were generated for us. So in that 3-4 month period, over a period of time, a lot of sell ideas were generated, and that resulted in a reasonably good cash levels in our portfolio. At the same time, we invested in companies which we thought will see increase in earnings in that environment and were not as well understood as business models. So that is why in that environment as well, where Nifty did not deliver any returns and a lot of even small and mid caps were not doing well, we delivered for that financial year 23, we delivered over 23-24% return. If an event like COVID happens, it's very difficult how one would react in that environment. What happens is, a lot of these times market gives you certain signals. If you look at what was happening in market even before that, markets started underperforming, and run up to COVID also, we were holding reasonable amount of cash. Some of those risks were visible. It's very difficult to say how we will kind of react when a black swan event happens again, and kind of very difficult to kind of talk about that on a hypothetical basis. But suffice to say that if it's an environment where we see a very sharp run up in number of sectors and stocks, I would believe that other part of our how we work, which is generation of sell ideas, will kind of work faster, and hopefully we'll be able to kind of have some protection in the portfolio.
Abhishek, it has been really, interesting conversing with you. And, I'll just take one question from the audience, because one of our clients has asked this question. Do you have uniform portfolio across various investors, or they build each portfolio as a different portfolio?
So a investor who came in 3 years back and an investor who came in 2 years back will have a similar portfolio. But an investor, almost replicate, similar, exactly similar, more or less. But an investor who came in 1 year back and an investor who came in 6 months back may have some difference in the portfolio, because some of the stocks which had run up may not may have come in the portfolio of investor who came in 6 months back. But the difference will not be very large. But an investor who came in 2 months back and somebody who was there for 2 years or 3 years, their portfolios can be little different, because some of these stocks, as I gave one of the names, since we talked about it, I can say that the GET&D is something that we continue to hold in the portfolio, but it's not something that we are buying for a new investor. There are different stocks that we are buying for the new investor to some extent. So typically, I'll say it takes 6 months or so to kind of have a similar kind of portfolio, and in a year's time, portfolios kind of look quite similar as we generate newer ideas and there is churn in the portfolio. So far, that's how we have observed over the last 3-4 years.
Sure, Abhishek. Thank you, Abhishek, for your time, and thank you everyone for joining in for this webinar. Before we wind up, I will just like to cordially again invite all the viewers who are right now logged in to join us on 23rd and 24th of February. We have our 5th annual event planned. It's planned really thoughtfully. There are 12 sessions, 30 speakers, and almost each and every realistic question that any investor has on his mind today, be it with regards to listed space or unlisted space, valuations or growth or upcoming trend, all are being covered with regards to all these 12 sessions that I talked about. So we have already seen more than 1,400 registrations. If you have still not registered, kindly visit PMS AIF World platform and register yourself. We'll be eagerly waiting to welcome you. And thank you again for logging in today for this weekly webinar. Thank you, Abhishek, again, for taking your time. It was really insightful. Thank you once again.
Thank you, Kamal. Thank you for this webinar.
Pleasure.